Our next and last panel discussion for the day is on the shifting regulatory and business terrain. To moderate the panel on this interesting subject, I invite Mr. Sourav Majumdar, Editor, Business Today on the dais. A huge round of applause for him. I next invite our esteemed panelists to join him on the dais. Mr. Varun Sridhar, CEO, Paytm Money Limited. Mr. Dhiraj Relli, MD and CEO, HDFC Securities Limited. Yeah, we can have those claps. You'll have your tea now. Thank you. Mr. Varun Gupta, CEO, Groww Mutual Fund. And Mr. Kalpen Parekh, MD and CEO, DSB Mutual Fund. Over to you, Mr. Majumdar. Hope we have a great panel discussion.
Thank you very much. And sorry to drag you away from the cup of tea which you all were enjoying outside. But since we are running a bit short on time, we thought we'll get into it right away. Like good boys, this panel follows the regulator's address. So that's been a good one. And there are some interesting points which the regulator made. And we hope to discuss some parts of that as we go along in this panel discussion. So thank you very much, gentlemen, for being here. And we hope to pick your brains on some of the most pressing issues which are currently before us in these times. I'll start on a broader level because the topic of this session is the shifting regulatory and business terrain. So I think if I may start with the mutual fund, pure mutual fund players, if you can throw some light on how the current economic situation globally and the headwinds which we see around us are affecting the economy and therefore the investing landscape, then we can take on parts of that as we go along. So we can start with you, Kalpesh.
The tougher question, you start with me. And as you rightly said, this is a phase where headlines globally are more volatile and worrisome, whereas flows locally are assuming that all is well. And almost all of us in the financial services, or at least the asset management industry, this industry started sometime around 98, 99 in terms of more meaningful growth. So it's been around a 20, 25-year journey. And this is a journey where we all came in the industry when interest rates in US started falling from 12%, were at 5%. So we entered at 5%. This 5 came down to almost 0 till 1 year back and is now back to around 4.5, 5. So our entire picture is from 5 to 0 and 0 to 5. We have not seen the picture above 5. So now in the next 5, 10, 15 years, is the next decade going to be same as the last 20 years or the prior 20 years will determine how various economic trends play out. And the only thing, while on one hand I'm very optimistic and hopeful that more and more investors are embracing investing, more and more Indians from savers are becoming investors. But what is equally important to discern is this is in a phase when the last 5, 7 years we've seen largely an upward moving market, an upward trending market with intermittently short periods of correction. So corrections have been short-lived in the last 20 years. In the prior 20 years, rallies were short-lived. And markets generally used to remain, anxious. So this is a very different regime, and a lot of lessons learned in the current 10, 20 years may or may not apply in the next 10 or 20 years. So I think it's going to be uncertain like always, but with higher intensity, with higher speed of volatility. And hence, very important that we as manufacturers or money managers who guide our audiences, whether our distributors or our investors, we remain prudent, we remain responsible, and we operate with the right guardrails in terms of setting the right expectations so that the hard-earned money of our savers continues to compound at reasonable rates.
Varun, to pick up from what Kalpesh said about longer rallies now, Do you think the new investors who are coming in large numbers, particularly over the last 2 or 3 years, are sort of getting used to that and then therefore little unprepared for the troughs that follow?
So sort of, yeah, means if you want to ask me in a nutshell, I would say yes, definitely the newer age of investors and the investors who have come in recent times have not really seen those kind of drawdowns which we have seen earlier, especially in, the subprime crisis 2008, and, they have seen one of it, but there was a quick recovery right after COVID. But at the same time, we have seen very different experience from investors, different kind of, behavior from investors. There are a set of investors who will definitely get discouraged whenever there are longer drawdowns. But there is, I think, a lot of investors now have started understanding that there is a volatility in the market, right? It is not going to be just a straight up rally. A lot of investors have started understanding that. So I think there will be both type of investors. I would say the people who have just started investing are still to understand what a drawdown really is. It will take them some time. But I think over a period of time, because right now it's not a very high bull market, right? It's still going up and down. So most people are getting educated about it. But yes, if there is a serious drawdown, like the way Kalpen has hinted, and it remains for a very long period of time, we might see a completely different investor behavior because these are all new age of investors.
Dhiraj, a similar question to you as a large, important market participant. What do you see as the key trends which these new investors are looking at, given the kind of economic headwinds we see?
So, in last 5 years or so, we have seen emergence of millennials, Gen Z in the markets, whether it is in direct equity or even in the mutual fund. I think the incremental customers, if you look at it, over 50% of incremental customers are Gen Z and millennials. Their risk appetite, their awareness level, and their understanding of the market is very different than it was there earlier. So this set of new investors understand that they are entering the market with their eyes wide open. They know how to navigate the volatility. They have understood the market, and the information arbitrage that was there between the institutional investor and retail investor have also bridged. To that extent, I think this is a far more matured set of investors than what we used to encounter or meet earlier. In fact, the earlier investors also, they have also seen the bounce of volatility. They have seen multiple time VUCA playing out, volatility, uncertainty, complexity, ambiguity, and have navigated multiple cycles. Now our mutual fund industry is far more matured than it used to be two or three decades ago. Nilesh is sitting in front of me. Nilesh and I go back 25 years in our relationship and grown along with the industry. I think we are the products of the India growth story, so I would say. But, I would echo with the Varun also that the behavior of investors have changed dramatically. Having said that, these kind of events do bring in some kind of worry, some kind of, anxiety in the short term, in an intermittent period among the investors. And that's where I think the credible players like HDFC Securities and AMCs and many more media partners like you really play a very good role nowadays. And in fact, the quality of the inputs that is given to the customers is also very, very different and much better than what it used to be. So there's less of ambiguity, more clarity. I would just add one more point here, that in fact the SEBI has also played a great job and played a very important role in ensuring that we create an ecosystem that is more customer-centric. Whenever there are regulatory changes, whether it is abolishing of entry load, whether introduction of the direct plans, or scheme categorization, introduction of riskometer, it creates a little bit of hassle for the incumbent players, and it creates some kind of a stress also in the system. But if you look at after some time, after few quarters, these norms have really added our investors' confidence. And if we want to scale from here, from 48 lakh crore of assets to 410 times what Amarjit Singh ji was talking about, ki that our mutual fund penetration to GDP, percentage of mutual fund AUM to GDP is 16%, and globally in US it is 80%, and Japan probably 47%. Even if we forget US and we reach to a Japan kind of level also, I think it is a 10x of a growth. Whether it will happen in a next 10 years time, 15 years time, 20 years time will tell. But we will reach there. So to that extent, I think the regulators have also played a very critical role, a very constructive role in making this industry more and more customer-centric.
And it's also a very quickly shifting landscape. So that makes everybody's job that much more challenging, right? Varun, to take off from what Dhiraj and Varun have said about the millennials coming in who are much more aware these days than probably the newer investors earlier, in the earlier years when we all started out. The other question is, having been more aware, they're also exposed to different kinds of asset classes, markets, for instance, crypto, digital gold. How has that changed the landscape or the skill sets? What do you need to do to change yourselves, both as market participants, mutual funds? And I'll come to the mutual funds players also after this.
Yeah, I think, first of all, good afternoon or good evening, everyone. At Paytm, at least for us, the way we look at this is, I'm very happy that the market's going up and down right now. There are a bunch of people who've joined. I think millions of, maybe at least 10 million odd people have come to the industry in the last 2, 3, 4 years. Now, there's a very, internal fun thing that we say, fail fast and fail small, right? I think it's so good that I was in a college speaking about a week back, and there was this 24-year-old who has a minus 20% portfolio. But the amount of the portfolio is 8,000 rupees. Smart kid, understands everything, is doing. I think that learning is precious, right? And I think that learning is what is going to change the situation. So it's better to fail now than have, a 20 lakh portfolio and then be uneducated about it. So as far as, look, we are betting very heavily on Young India. Young India is far better than at least me and many other people sitting here. They have better access to technology. It is better, right? And therefore, I think the level of that investor is very, very high. Now, what should we do as an industry? I think, I would put my money on 3 things, if you may. First, I think we need to stop talking in English. वो हमें NAV तो किसी को समझ ही नहीं आता है, honestly. वो मतलब क्यों NAV है, क्यों unit है, every message from the AMC, and I have a bunch of AMC CEOs here who are ex-AMFI presidents or AMFI presidents, and it's an important bunch of people here. Why is our industry in English? I've just not understood it. You can't explain it to a Tamilian. I'm a Tamilian. You can't explain it to a Marathi. You can't explain it to a Kannada guy, right? When we fight at home, we don't fight in English. Have you ever fought at home in English? नहीं करते हो ना. आप झगड़ा करते हो, किसी से प्यार करते हो. When you are with your friends, the language is different. And I think the industry needs to flip. So that's the first thing I would do. The second thing I think is, somebody was talking about 100 rupee as minimum SIP. I would love that the manufacturers, because I'm a distributor. At Paytm, I keep asking every AMC CEO, कब मुझे 1 रुपए का SIP दे रहे हो? Right. Because I think we need to start thinking. अब problem क्या है? 1 रुपए के SIP में is the cost. Right? The cost of the transaction is too huge. But I look at a parallel. Let's look at UPI, right? And I'm sure everybody here is an advanced UPI user. I really admire AMFI and the AMCs for one beautiful thing they've done, which is mutual fund sahi hai. I think it's fantastic. If there was one thing I think the industry deserves a big applause is for mutual fund sahi hai. But maybe this year and the next 2 years could be mutual fund ki technology sahi hai. Right? Can we become instant? Can we do instant anyway? Because the Indian consumer has forever been sold Maggi noodles for 2 minutes, and now UPI, which is instant. So for him or her, the mutual fund transaction is the only transaction if you do on Friday, you get your NAV on Monday. He's asking, saying, "Ye kya ho raha hai mere saath?" Right? There's no instant gratification, and it's not simple. So the second thing I would do is invest heavily into technology as Paytm. And I think the last very simple thing for me is, how do we convert and bring, somebody had asked a very interesting question around pull versus push, distribution versus manufacturer. I think we have fantastic manufacturers. I really think we miss distribution, and we miss advice and distribution, right? I wish there were far, far more number of distributors on the ground, and in digital technology, because only then we can have 100 million investors, right?
So very valid points raised by Varun here. Kalpen, would you like to take on the point about the cost versus the smaller size of SIPs? What is the mutual fund perception on that?
So I think it's a fact, right? The costs overall are rising, whether it's regulatory cost, transaction cost, every time an SIP. I think the glory of our industry, everyone talks about every day, including to FIIs, is the growth in SIPs. But every SIP installment, there is a cost. Exchange level cost, demat level cost, custody level cost. So I think the whole ecosystem has to think how to bring costs down, not just at the asset management level, so that ultimately it migrates to the investor. And also I think I have a slightly different point to what Varun is saying. I was just observing all of you are in blue and black, and I'm not wearing a blazer or suit, so I need to differentiate a little bit. I feel that this business is about really long-term compounding. And we want investors for decades, not for hours or weeks or months. So it doesn't matter whether he gets his units today or real time or tomorrow, because I also feel this growth of technology and access is also creating so much of non-stop noise and stimulus in the minds of the consumer. In fact, in the last 10 minutes itself, in my mind, 20 different contrasting thoughts have been coming. So extra information is actually an enemy of long-term compounding. The more we are in front of the consumer, the more is the stimulus for him to think, should I be bullish, bearish, should I get in, get out, view positive, negative, which sector, which stock, which market cap. And every day there are hundreds of discussions like this. Every day there are hundreds of industry influencers and outside industry influencers who are giving so many messages on different channels with many times contrasting opinions. And there is no way to validate what is the real expertise, because the real expertise will be known only 3 years later. So there is a need for some amount of balance and quietness, because otherwise we will not be able to build on compounding. It's been a long, tough journey. I remember 20 years back, the mutual fund nahi hai was important, because many investors used to say, yeah, mutual fund risky hai, and from there, a huge progress of mutual fund sahi hai. And the real benefits will be seen only when the investor stays invested for decades, because in 3-4 years, what compounding will he make? And there will be 7, 8, 9% return per annum for 3-4 years is not going to change anything. So I feel there is need for some bit of quietness in the way we engage, and also make them more long-term. I keep telling my own tech teams and digital teams, because we keep discussing. Today we had a 2-hour meeting on what type of features we add on our mobile app, what type of nudges we give, how often we communicate. And I've been telling them that every Sunday I have to sit and, so many brands are writing to me, happy birthday, happy Diwali, happy Raksha Bandhan. Gold, this fund is launched, this fund is right for you. Every fund launches different categories, and everyone says this is the right category. So which one is the right category? So quantity is leading to more confusion, and more so in today's world of very low attention span, wrong decisions at times. So it's important to search for stillness, to aim for achieving compounding.
Varun, I want to come to the point of how difficult or how challenging has it become for mutual funds to now plan the perfect portfolio, given the fact that earlier it was about, basically large cap, mid cap, small cap funds, and, categories were limited. Today you have this whole surge of passive funds, then you have IoT, AI, ML, the whole gamut of new sectoral funds which are coming, new segments. How difficult or how challenging has it become for fund houses and fund managers to plan perfect portfolios around these new trends?
So Sourav, I have a little differing point of view. There was a similar question asked in the last panel as well. See, I firmly believe that it is the responsibility of the manufacturer to keep on creating products. Correct. Right. Basically, we have to continuously keep searching for alpha in the market. We have to continuously keep searching for different investment options in the market, right? And we have to have all the options, right? We as an AMC, we don't say that we are a passive only AMC or we are an active only AMC. Because in India, and as had come out in the last panel and is coming out here as well, it's a very, very diverse market. There are different investors with very, very different set of requirements. There will be investors who are very learned, who will decide that they want to invest on their own, so they will go for passive, they will rebalance the portfolio on their own. But most of the Indian investors, 90% plus, need handholding, right? They need some or the other advice, right? So, and there are different products which are available in the market, for which there will be always a middleman, always a set of advisors or distributors who are supposed to give them that advice. So I would, just to flip your question a little bit, I don't think that mutual fund industry or the mutual fund manufacturers are going to look at that this is the portfolio creation complicated for me. I will always go and create a scheme with a certain objective, looking at where I can provide an opportunity to my investor, and then I will have to educate the distributor, or in some case the end investor, very clearly communicating what that scheme stands for, and wherever possible, a distributor or an advisor or an investor has to take a call whether they want that scheme in their portfolio or not. If you allow me for one more minute, I want to take that question, because I think that was a very interesting, which Kalpen also answered, and Varun also answered, is about that crypto and different things. And again, Nilesh pointed out in the last panel again and again that there have been a lot of Ponzi schemes, right, in India. And a lot of these Ponzi schemes, there is always just one selling point. Right? There is a one person who is saying कि मेरा पैसा double हो गया है, मेरा पैसा triple हो गया है, and a group of people will keep on, investing in it till it becomes a full-blown Ponzi, right? And it has happened over and over again. And you were asking what mutual fund has to change, right, for us to compete with it. I don't think we require to change anything, right? I firmly believe we all are remembering a time where pre-COVID we were at 2.25 CR and now we are 4 CR of investors. I remember 2015, we were only 1 CR of investors, right? And it has taken us about 25 odd years to basically reach that. And now we are doubling every 4 years, right? What I really believe, or what we call in, in tech circles, is that we have reached an inflection point. The activation energy is all done. We have reached a point where there is enough education now for investors, right? Mutual Fund Sahi and many other campaigns have basically reached out to the last investor, and now people know mutual fund. They might not be investing, but they know what mutual fund stands for. There will be a time in their life when they will decide to invest or start an SIP. That might not happen now. They will burn their hands with crypto or other things, and then they will probably come back. But as an industry, I don't think we need to change anything. We just need to keep on creating wealth or keep on creating products for investors.
Keep on saying कि mutual fund sahi hai.
Mutual fund sahi hai.
For the safety of the investor.
Yeah, we have to be the long-term message proponent, like the way industry stands for, and over a period of time, investors will keep on recognizing and keep on coming in.
Dhiraj, your take on these new categories of investments and packages which are coming in terms of the themes, and how you think the markets and fund managers need to adapt. I think Varun made the point that you need to just create products which are useful for both investors and distributors understand them. What's your take on that?
So India is a very diverse market, and if you slice and dice the customer base also, you will see that customers are there on the top of the pyramid where they need a high-end advisory services, and right at the bottom of the pyramid, they would just need an execution-only platform and a very simple one-click simple solution. So, and in the middle, you will have again different set of segments of customers also. So I, to an extent, agree that the product manufacturers will need to keep introducing more and more products. It is up to the investors to look at what meets their risk appetite, what serves their purpose, what meets their investment horizon, and accordingly invest in that. And I do believe that the platforms as well as distributors will continue to play important role here. Some of the solutions will be very simple, which you can just go and pick up from the platform and invest directly, do it yourself also. And as your requirements get more and more complicated, your requirements will require some kind of a calibration and advice. That's where the advisors and distributors will pitch in. So introduction of new products, new offerings are good for the investor community at a large also. So that to that extent they satiate or meet the appetite of that. On the point of increasing the participation. Today we have about 4 crore unique customers. Folio wise, we may have about 15 crore folios, 14.9 crore folios to be precise, what I saw as a data. And that's something, if for that, we need to have a lower ticket sizes. I do agree with that. Let's get people to get to taste these mutual fund options and understand the product. A lot of concept selling is required. I can tell you, 25 years ago, late 90s and early 2000, when we were telling investors that systematic investment plan is a great option, some of the investors were exposed to at that time with the monthly investment FD options, RD, recurring deposit, what banks used to call, but SIP was a new concept for them. And from there, in just about 2 decades time, where we have reached, where we are almost, having over 16, 17,000 crore kind of SIP throughput value coming in every month, and 7 odd crore SIP is running. So we've progressed very well, but lot more to be done to include. When you look at 4 crore unique investors, this is not even 10% of the total number of Indians with the PAN card. We have over 50 crore Indians who already have a PAN card. So to that extent, the addressable market is really 10x of what we are currently having. So having a different, simpler product, lower ticket size products will serve the purpose of the bottom of the pyramid. Thematic funds, more complex products, portfolio, fund of funds, flexi caps, and so on will serve the purpose of more evolved, more experienced customers also.
That's right. Varun, I want to ask you about this whole rush of new fund players coming in, new fund houses, after a long gap. And many of them are disruptive, many of them in their earlier businesses, many of them have very good technological prowess. Now, how is that, how much of that will impact the current mutual fund industry players, and how disruptive actually can mutual funds eventually be? Because ultimately it is about offering the best product, like Varun said, to a clutch of investors and to the distributors. So how do you see this influx of new players all in one, many of them coming in a rush?
You should ask this question to the other Varun, because he's the new entrant.
That's right.
I'm not.
No, but then that would be conflict of interest.
He's a mutual fund CEO, so he can manage conflict. No, but I think here is my point of view. I'm glad that they're coming. I think I would welcome them with open arms, and I would say it's fantastic to see new people coming. Look, at the end of the day, 40 million people having a mutual fund is very small. Just think about UPI, and I go back to UPI again and again. Why did NPCI succeed? One pin pad. Across India, 11, 12 billion transactions happen on one pin pad. I don't know hamari dal roti kya hai. Right? What is our basic staple food in the mutual fund industry is missing, right? Now, what's happening, I think, is because of the new AMCs coming in. Each one of them has taken a passive-only approach. I hear Varun from Groww saying, hey, look, we'll be active passive, or at least that's what I interpreted. And there'll be different players who will come with different things. Somebody's going to come in and say, I'm HNI only. Somebody's going to come and say, I'm international only. Somebody's going to come and say, I am going to do, I don't know, Bata ETF, Birla Ambani, Tata Adani, right? मैं सिर्फ यही करने वाला हूँ. So what I like about competition is competition pushes incumbents to change, which is obvious. But I think what it also does is incumbents realize their true skills. I think, if you look at the top 10 AMCs, I can literally tell you customers, eyes closed, invest. And digital platforms like ours show you everything, right? I don't have an RM calling you and saying, sir, ये fund खरीद लो. There is no RM. आप जो भी करते हो खुद करते हो. So जब आप खुद कर रहे हो, and when you're doing it yourself, the one factor that differentiates my distribution sales, if you may, between AMC and BMC is trust. And I think trust will take years to earn. So now the question is, if trust is not on your side as a new asset manager, what is? So I think they'll be forced to innovate. While the earlier ones in my mind, while they should innovate and they will, I think they will also realize their value. But as far as a consumer is concerned, I think consumers are in for an exciting period. I can only tell you that...
Spoiled for choice.
Yeah, I wouldn't say spoiled for choice. I hope it's not Nifty fund only. If everybody launches one more Nifty fund, Paytm app में दिखाना मुश्किल हो जाएगा. आप सोचो कि मतलब 44 AMC हैं और let's say there are 100 more. there are 56 more with join, and let's say we have 100 AMCs, I don't know how a consumer is going to filter 100 nifty ETFs, with one having an expense ratio of 0.21 and the other having 0.22. I think then the industry has gone wrong. So I'm hoping the new ones come in and decide to really bell the cat and take a strong position and do something new. I'm also hoping the new ones solve technology, cost, language. Because if they do the same thing, industry won't change, right? So, yeah, but I'm more than happy.
Kalpen, your take on these new entrants as an existing player?
One, we have no choice but to welcome, because that is the order of every industry and evolution, that wherever profit pools are there or expected to be there, more people will come. And as Varun said, good for consumers because choice is there. Of course, it can create confusion also. So I feel it will only lead to more progress for the industry, for the consumer, and it will also keep existing asset managers also on their toes, wanting to constantly think, what can we do better, how can we differentiate. In fact, like I said in the morning, we had our digital meeting and we were discussing what can we do so that Varun gives attention to our strategies. Because these are the guys, it's not just the asset management companies, it is the way distribution itself is innovating. Yes. Dhiraj launched this amazing Sky. So our guys were actually going through the app, saying what are they doing better than ours, now which in normal world we wouldn't have done. So we have a team which actually looks on, comments on Paytm, by Paytm customers on what they like and what they don't like, so that, we look back that can we improve or not. So I think this, new fresh blood of innovation and, thinking consumer first is an extremely valuable shift or a pivot in the industry.
And tech-driven.
Sorry?
Technology-driven.
I think consumer-driven, using technology as an enabler. I don't think they are starting by saying that, okay, we are tech. I think when I meet them, I start with this thought. They start by asking that consumer ka kya problem aap solve kar rahe ho? And then uske liye how can tech be used? One of the person in Bangalore who is trying to do something very similar, they actually say that, and this is an insight I want to just share, they say that traditionally whenever there is a budget or a credit policy, most, not just asset managers, but everyone in the world of finance and money will create a 50-page document and send it to everyone. No personalization, no customization, no relevance mapping. Whereas some of these guys will say that this consumer, if he's coming in from a small city on my app, and for him only how the cigarette prices have been changed because of duty, let me only give that snippet to him on the mobile. And if this guy is coming in, if it's a female investor coming in, let me only give 3-4 snippets from the entire budget which are relevant. Now, the whole idea of today's world technology is enabling understanding of consumer, who is it, what time is he coming in, logging in, what is he looking at. So I think we will learn, and hopefully the partnerships will progress and add value to the investors.
One point which the whole-time member of SEBI said in his speech, which is actually very important as a point, is the limited reach of the mutual fund sector, despite the higher numbers. It is still limited to, say, top 30 cities, and not really spreading to the extent the mutual fund sector would like it to be. Now, what do you think, Varun, can be done to extend the reach? One, you of course said bringing down the ticket size is one option, but spreading it, bringing down the ticket size may increase the numbers, but what about the reach? I think the reach is the issue if you want to really say mutual funds are here to everybody.
Right. Very, very interesting question, Sourav. Thank you. So I have a lot of thoughts here. I will try to structure it a little bit. See, first of all, I completely agree with what Mr. Amarjit ji was saying. We are still looking at where we were and saying that we have reached 4 crore and we are saying, okay, that's great. I am sure this number is going to double up more before and faster than we can even realize, right? There is in any industry, or especially in our industry, which is more knowledge-based, which requires a certain bit of, a certain bit of distributors which requires education, right? Which is not really taught to the end investors. We need a certain tipping point. We need an inflection point, which I think now has been reached by constantly telling people that mutual funds are here. Mutual fund has become a name which people recognize. People might not be investing, but they recognize. And that itself is a tipping point, right? So, but as was one of the key things, I think, which was coming up in the last panel also, that there are distributors who are addressing different markets, different industries, different segments of users in India. We have distributors who are addressing the top of the market, which is, you will find a lot of MFDs or HNI, wealth companies, which are in top tier 1 cities, T30 cities. Then you find a lot of digital companies which are primarily bottom of the pyramid, right? They are catering to users who are 500 rupees SIP, 1000 rupees SIP. But there is a large segment of middle India who need hand-holding, who needs advisory, which is still finding whom should I go to, whom should I go get this advisory from. And then they of course cannot be catered by the top tier of the, of the distributors or the wealth managers, and not definitely by the digital players. So for us to reach out to that, I wholeheartedly believe that there has to be a very long tail of distributors. We don't have sufficient number of on-ground distributors, which this country desperately needs, right? Insurance, as was pointed out by Mr. Singh in the last, it has 2 million plus distributors. We, in our industry, which is less than 1 lakh, right? So what can we do to basically increase those number of distributors? How can we enable them in the new context, right? As the way industry has evolved, how can we make this business sustainable for them so that they basically serve the end customer?
And also train them because of the
Yes.
emergent technologies and the emergent trends.
Absolutely. So that is one of the key challenges we have taken up in our AMC, because we believe that end customers can be served only by a distributor. You go to UP, right? You go to any city, like I am from Ujjain. I go to Ujjain and no one is investing online, right? There is people, if they invest online, they will only invest, let's say, like 1% of their overall net worth. As soon as it crosses a certain point where it becomes a substantial money for them, they need someone who can come and tell them where to invest. Right? So I firmly believe that is the single answer, that we need to create a long tail of distributors, or the existing distributors have to start increasing and reach out to different set of investors. And we as an AMC has to, or we as a group of AMCs have to work in that direction.
Dhiraj, your thoughts on that?
Yeah, I'd like to add one point here for sure, that I think we are missing one plot here is that affluence. Currently, we are a low per capita country. We are just at about $2,500 per capita. The moment we reaches to 5,000, which will happen in next 4 to 6 years' time, I think that would change the fabric of the society. The consumption will also be at a very different level, and the savings will also be at a different level also. So that affluence is required to get more and more participation. Right now, large part of Indian population is busy in meeting their basic needs only. So that's something, with change in the per capita, the things will change, and that's where we'll see more and more participation coming in. Of course, the reach and richness of offer has to be there to get more and more investors to participate in the mutual funds. As long as the reach is there, which is through either distributors or through the digital platforms, both will work hand in hand. My take is that it's not either or strategy. It has to be both strategies, and also richness of offer also. It has to beat the underlying comparative asset class, which is fixed deposit. Today, if you look at mutual fund AUM as a proportion of fixed deposits or total liabilities in the banking ecosystem, I think it's just about 24-25%. If 48 lakh crores, and my last memory, if my memory supports me right, it was 188 lakh crore in the banking liabilities in the banking system. And so it's just about 24%. And this is growing at, mutual fund AUM is growing at a 16% CAGR, whereas deposits have been growing at a 11% CAGR. From that point of view, I think by 2030, on an enhanced based, it would be a third of the total disposable investments that would be available in the market. So one shift from deposits to mutual fund, different asset classes in mutual fund, and on top of it, financialization of savings, money moving in from real assets to physical assets to the financial assets. I think that's something we need to work on, and of course the distribution will help in this.
Talking about distributors and reach, and regulation, therefore. One aspect, Varun, which I want you to talk about, and we can ask the other panelists as well, is about finfluencers. And you know what SEBI's thoughts are on that segment. And not all of them, mind you, are on social media. There are those who are outside also and unregulated. What is the way in which one would look at that segment of so-called finfluencers and the way the regulator has been clamping down on them?
Yeah, I'm happy finfluencers became a word, right? एक तो dictionary खुल गई Oxford में, I think अभी finfluencers की entry हो जाएगी, which is already good. B, I think the fact is, finfluencers has become a chai pe charcha for all of us, at least in the sector, on what to do, what not to do. I think that's fantastic.
May I add that Business Today was one of the only ones which did a cover story well before anybody on finfluencers, you know, and what they're doing.
No, and I'm glad that media picked it up. I'm super happy that the regulators picked it up. I think it's just fantastic, right? Because look, eventually somebody needs to advise, like he said, because ऐसा नहीं है कि सब लोग what's the problem? The fundamental problem our education system makes great architects, chartered accountants, engineers, doctors, AI engineers, but literally they don't teach 500 रुपए की SIP कैसे invest करनी है. कोई नहीं सिखाता. So you pass 12th, you go to IIT, you become this great scientist or whatever you want to become, but you don't know how to do 500 rupees of personal finance management. So like literally, and I think that's the root cause. Because there's a root cause, there's a deficit. Some people, in my mind, find it as a great opportunity, and there is monetization at the end of it. Let's be clear that at the end of the day, why would you do 1,000 Twitter posts? Why would you do 100 Instagram posts, set up a camera, do all the hard work? It's not cheap, by the way, right? You ask a fin-influencer their cost, it's an expensive cost. Now, here's my thing. I'm glad it's getting regulated. I also think if regulated and channelized properly, I think it can be a great benefit for everybody, right? I personally believe that there are very good fin-influencers, then there are very bad on the other side, and in between there are people who are trying to figure it out, who have knowledge to share. And look, India at 1.3, 1.4 billion people, we'll fool ourselves if we think sub-segmentation nahi hai. Right. That there is no small group running on Telegram, WhatsApp. Now, I think all that needs to be done, and it's a first step. I'm sure the industry will do a great job of it. I'm very, very, very proud that SEBI is a regulator. Many times we don't like it, right? It's awful, but I think the times that it's there, this topic has come. In my mind, next 2-3 years, there'll be multiple regulations, hopefully, on this topic. And we'll reach a situation where we will say, ye certified, transparent, honest influencer hai. And because now all on the exchange is under something called UCC, yes, which is unique client code with one PAN number, I think the advantage is now, for example, if Varun wants to be an influencer, can I put my numbers out there? Yes, I can. So if somebody wants to verify, have I made a profit or not? Am I mis-selling? All those things are transparent, thanks to technology again. So my feeling is registered influencers where there is some monitoring so that they're not taking the gullible for a ride, I think is a great, great future. What we should not do in my mind is say, sab kharab hai. All this social media is nonsense. Technology is bad. Technology is too fast. Because the minute you do that, technology is not stopping. I think we will have to accept that that world out there is like water in an ocean. You can build a dam around an ocean, but I don't know how many dams you've seen lasting around an ocean, or how many have even been attempted, right? So somewhere I think that regulation needs to become positive, and as people join, I'm sure that system will evolve. But I'm happy with the regulated fin-influencer system.
Kalpen, your thoughts on that before we're running at the end of time. So a couple more questions and we might have to throw it to the audience also for a couple of them.
I have worked with Nilesh very early in my career, and I briefly worked in a company which had deep influence by Rajiv when he was the CIO. And both of them, they speak less, but what they speak, there's a lot of learning. Rajiv, I think, maybe having 12,000 followers on Twitter because he has stopped expressing a lot more these days. But whenever he used to, deep learning, as an investor I would have got. Nilesh, again, only 5 lakhs or 6 lakhs. Now, I think the quality of learning as an investor I may get from just following these two people would have been immense. It is probably 2 or 3 decades of learning which comes there. But for whatever reason, consumers would not like to follow either because they have to get more interesting. Or they need to dance or, not be what they are. And also become more simpler which, let's say, on the other hand, you know, a lot of younger audience who are talking the language that our consumers today relate with. So I think there is a need for fine balance. But I also feel, apart from regulators doing, you know, and they've been doing a great job in making the industry safer, I think it is one of the safest industry for our consumers anywhere in the world, compared to any other sector also in India. And I also think a lot of onus should be on consumers in terms of deciding who should be their role models and who should they want to learn from. Because end of the day, it is my hard-earned money. I cannot think that, okay, someone else gave me a wrong message and I lost my money. Ultimately, most money is lost to greed and wanting to make quick returns. So I've always, you know, learned this lesson slightly late in my career that don't chase five-star influencers or fund managers or, you know, icons. Try to become a five-star investor yourself. And that responsibility can only be yours. You can't outsource it to anyone else.
Hey, yes, you wanted to add.
So influencers largely have more issue in the direct equity side and less of an issue on a mutual fund side. Even if a customer invests in a scheme which is in bottom quartile also, you still may be better off in terms of your investment as compared to the other options available in the market. So here there is a very limited speculation. So to that extent, I think it's a very well protected, regulated space, and the number of schemes how they govern are very easy. You get only one NAV a day. I think we'll have a days when we'll get multiple NAVs in a day, then we'll have an issue. And
That's what he wants NAVs quicker.
That is some
Varun
speculation
wants
will
NAVs
come in
quicker.
then. Today, I think if influencers, where they make more dent is that they try and create liquidity in the some of the liquid stocks, penny stocks, and promote low quality companies without making it absolutely clear to the investors and misguide them on some of the asset classes which are not regulated by the SEBI and so on. I think that's where we need to have a checks and balances, and our regulator is quite proactive, and as and when they get to know about some of these practices going on, they take action, and it's a welcome step by the regulator. I believe that every influencer, if you want to influence and create followers, should get registered with the SEBI and do the needful. Then after that, you know, the checks and balances are in place. It's not bad, but it has to be governed.
Talking of regulation, and before we throw it open to the audience, one last question to the panel, and maybe Varun, you can go for it first. Is there have been instances that mutual funds have also come under the scanner of the regulator for allegedly unethical practices. Now, some of those are pretty high profile. Some big mutual funds have also been hauled up, or fund managers have been hauled up for that. What do you think the mutual fund industry, when you say sahi hai, when you want to really increase the spread much beyond, and there is enough headroom, as we've just discussed, what are the 2 or 3 things you would like the mutual fund industry to come together and do to ensure that these practices are completely obliterated?
So I think, first of all, we are managing other people's money and hard-earned money. So regulation starts from that first point of fiduciary responsibility and ensuring that in everything that we do in our intent, we keep that, you know, first promise in mind. Whether we earn 1% higher or lower return is secondary. So that's a given. And like I said, I started in 98 in this industry, and we are in 23. In 25 years, I have seen in every passing month the industry becoming safer and better. There could have been few, you know, accidents or few of these incidents which have happened, but at large, and I can speak on behalf of our industry, not just because I'm a part of AMFI or the industry has only become safer and better. And what can we do still to, you know, minimize or eliminate these accidents is to, first it starts from intent, and I think that intent is very much there. The second is how can we use more of data and technology to, you know, identify if there are some of these irritants or some of these small gaps or errors which are there, and try and keep plugging it at every point in time. But I genuinely believe that at large, the industry has a very clean intent of, you know, helping investors achieve better future.
Varun, yes.
I would echo what Kalpen is saying. I think it's a question of few bad apple or accidents. Other than that, I can confirm, because I've been associated with most of the asset management companies for over 2 decades, I can tell you they have their own checks and balances and ecosystem in place, and they are more cognizant of their own reputation, because at the end of the day, they have a fiduciary capacity. They have a fiduciary role to take care of the investors' funds. So they have their own governance and very good governance in place. On top of it, if you look at some of the initiatives taken by regulator, like categorization of the schemes, when you are investing in an IPOs, you specify which scheme you are investing in, and so on. I can go on and rattle many more such initiatives to substantiate my point, but our governance, our overall regulatory framework and ecosystem is far more credible than these noises or few incidents we get to hear.
Would you, as the newest entrant on the dais, would you like to?
Yeah. So I'll just, I think Kalpen and Dhiraj have covered almost everything, and I echo exactly the same thought. So let me try to answer this in a different way side. So we are a new entrant to the AMC industry. And I think we completed the acquisition only in June. So about 4 or 5 months. And I recently started, so since then only I started getting into the AMC side of regulation, what all compliance we need to follow. And I don't think there is any scope for, honestly, like I come from the stockbroking and mutual fund distribution side, and versus that, the kind of regulation, the kind of compliance which is there, if I am not, if I am not wrong, it is at least 10x, right? And I don't think there is any scope for people to do anything. And what you see is, of course, like what we end up seeing once in a blue moon when we see anyone, doing wrong, is usually a very largely an intent problem, and it can easily be solved. Intent, of course, you can't control, but has to be technology-driven checks and balances, right? That's all I think is the answer to it. But I think the regulator has done a fabulous job in controlling wherever the issue could have been, the kind of reporting which exists. Inside an AMC also, every function is independent of each other, right? And they are controlling, they are not answerable to each other. Fund management is not answerable to compliance, but compliance has to make sure they are directly responsible with the regulator, right? So they have to ensure that everything is happening correctly, operations for that matter. So I think there are good enough regulation is there. We just need to put anything which, wherever we see an issue or we find out, we have to put checks and balances technology-led.
Kalpen, you wanted to say?
I just wanted to add, see, one is external regulation, which, like I said, has only strengthened, but an investor will feel more safe and secure when he knows that all these money managers who are managing, all these asset managers, they have the intent to, safeguard us. And I'll give you an instance. In, one of our board meetings, one of our directors, we were just showcasing what are our investor education efforts. And we were trying to show these are the few campaigns we are going to do. And one of our trustees actually asked this question that in this campaign, I don't think I'm getting educated. So where is the dimension of education in this? So there is a very, nuanced role that the stakeholders, the trustees, the directors, where the intent is right, they also take that responsibility. They know that they are on the board of a money management company, fiduciary role, and those questions are asked, those dialogues are done. If funds are not doing well, there are times some of our trustees would say, you're not doing well in 3 months or 6 months or 1 year because you're following a certain, disciplined approach of investing, it's okay. But if you're not doing well over a 3-year, 5-year period, then, because on behalf of investors, they are accountable to ask these questions to us. So there are genuine discussions like this which happen, which I just want to, through this platform, highlight that it's not just the professional teams at the asset management companies, but even trustees play a very sound role to safeguard.
I think we can go on with this discussion for much longer, but just a quick couple of questions from the audience, and then we'll wind this up. Anybody wants to ask any questions to this? You'll not get a better chance. These are the best names you can find in the segment. Yes, please.
Hi. So, Kalpesh, you have been saying that there hasn't been much drawdown since last 25 years. And in case the interest rate remains high in US and even in India, and now we are used to long-term CAGR of say 15% or 16%. to investors, and investors also is expecting that as a right, what happens in case it comes down to 10% or 12%? So what should be, as an intermediary, our role to communicate that what is the kind of return you can expect in, say, next 7 to 10 years? I'm not saying 2 to 3 years. Should it be 10 to 12%, which is not very impressive to them? Or should it be as, like, say, 13 to 15%? Or if you go to small cap, it would be 17 to 20%.
Glad you're asking this question and not just taking the past returns for granted and extrapolating it. I feel, the underlying where we are putting our money is an uncertain underlying. Returns are always going to be uncertain. In fact, one big learning I have had in my career is, never sell returns. No doubt consumers want to know returns, but that's where we need to find that right mix. If you really want to build a very stable base of consumers or customers who come with the right understanding. See, one big challenge when money is coming in today, let me give this nuance. Today, 10-year returns look great because 10 years back, the market was at 11 P. Today, half of the returns have come only from multiple expansion. 20 years back, in 2003, again, the market was at 11 P. So 10 and 20-year milestones look actually great. But if you just make it to 15 years, which is 2008 peak, the returns come down to around 9%. The range of returns is going to be, low, medium, or high, depending on start point of that investor and the end point of that investor in terms of when will he need that money or when he will panic and get out. And different things will happen. So there is no one return. Each investor will have unique return depending on when he comes in, when he goes out, how he behaves in the journey. So it is going to be very dangerous if investors come with anchors of 12, 13, 14, 15, 16% returns, number one. Number two, markets don't give us the returns we want. Markets give us the returns we deserve. So it's very important to know that generally, and that's where a lot of study needs to be done of history, of cycles, and asset classes around the world, not just in India. There are countries where for 10, 20, 30 years, real returns have been zero or negative. In fact, there's a study which showed that over 60 to 80 years, and in case of India, over 40 years, because our data is slightly lesser, real returns over inflation by equity markets fluctuates between 0% to 5%. So over inflation, you would have earned around 5% more, and the highest returns, highest real returns have come to US investors and Indian investors, because incidentally, both these markets are also closer to, a high in terms of valuation. And there will be phases when that real return could be lower. So what we need to educate our investors is, if you don't come to equity funds or mutual funds, anyways you are, residing in lower range of returns. Ultimately, Nick Murray says that the single most objective of investing is to retain your purchasing power or grow purchasing power and earn superior returns over inflation so that our purchasing power remains higher. I think somewhere as an industry, whether it's money managers, media, distributors, the anchoring has gone to fund comparison, return comparison, alpha, beta, but not the fundamental point that are you earning more than inflation over the next, in your future tenor. And that's where rationalizing expectations and talking about what are the real expectations one should have will become very important. I genuinely believe that if investors come with 15% expectation, if we are lucky, we'll get it. I hope we all get it. But, you can't predict what, let's say, your business revenue is going to be in the next 1 year. No consumer knows what is going to be his increment or salary 1 year, 2 years, 3 years from now. How on earth can we know what is the return I'm going to earn over the next 10, 15 years? We try to generalize. So broadly, the simple thumb rule is over inflation, 2 to 5% is the range of return in different market cycles one has made. If you have invested in a bear market, you get the higher range of that return. If you invest in a super bull market, you get the lower range of that return. Now, depending on time horizons, as an advisor, you can mix and match products and asset classes, and also depending on the behavior and the risk profile of the customer. But having a 15% anchor is dangerous. In fact, you do rolling return studies. If there are 3 crore investors in the industry, I don't think more than 10% would have earned 15% return. Most investors would have earned lesser than that. So it's good you asked this question, but it's very important to see what are the odds, what are returns. You do this homework in your own. If you are managing 500 investors, you just see what is the holding period return of each of them, and how many of them have earned 15. What is that ratio? What are the odds? What is the base rate? And the odds are returns will be inflation plus 3 to 5% broadly. But there are times it could be other way around also, small probabilities. But at large, odds have been inflation plus 3 to 5%. In India so far.
Just one question on this. So there has been an industry, example of it being real GDP growth rate plus inflation. So in last 20 years, that has been around say 14, 15% or 13%. That's why maybe it was high. But now because we'll be in low inflation era, we believe, so it can be 10 to 12%. Can we give that kind of an example? Will it be appropriate?
Yeah, so I think that's another simple hack or a simple way of explaining that long-term GDP returns is what you see in your market returns. Generally, in the very long term, over 25 years, GDP plus inflation has been around 11 to 12%. So Nifty returns also have been around 12 to 13%. Now, in the next 10, 20 years, we don't know what is going to be the GDP growth rate or the inflation. Generally, inflation has trended lower for us compared to last cycles. GDP growth rates also will have cycles. There was a regime, 10 years back, we used to aim for 8 to 10% growth rates. Today we are happy with 6 to 7 also. At 6 to 7 also we say we are the fastest growing in the world. So these things change. We may have less memory, but I remember 2000 heady days of 3 to 8, 10% seemed to be birthright. ये 10% तो हमारा बनने वाला है. बट वो 2008 के बाद एक साल ऐसा नहीं आया है जब जीडीपी 10% से ग्रो हुआ है एंड दैट इज ऑल्सो नाउ रिफ्लेक्टिंग इन रिटर्न्स सो इट इज अ कॉम्बिनेशन ऑफ ब्रॉडली द एवरेज ग्रोथ रेट ऑफ द जीडीपी एंड एट व्हाट प्राइस यू आर एंटरिंग इन सो दीज आर टू थिंग्स यू हैव टू कीप इन माइंड
Any more questions can be asked after the session is over. They'll be here. You can speak to them after that. Thank you very much, gentlemen. This was an absolute pleasure. Thank you very much for sharing it.
Thank you, panelists. May I now invite Mr. Rajiv Anand, Board Member of Bombay Chamber and Deputy Managing Director, Axis Bank, to present our panelists with a few mementos. We'd also like to have a group photograph. Request for a group photograph, please. Mr. Anand, can join them. Once again, a huge round of applause for a wonderful panel. Thank you. Mr. Rajiv Anand, we would like to invite you for your vote of thanks.
Good evening, ladies and gentlemen. My name is Rajiv Anand. I'm indeed honored to deliver the vote of thanks at this conclave. On behalf of the Bombay Chamber and on my behalf, I extend my sincere thanks to each one of you for being present here and for being part of this highly engaging conclave. At the inaugural session, I thank Shri Amarjit Ji, Whole-Time Director SEBI, for gracing the occasion and delivering an illuminating keynote address, and Nilesh, who's always engaging, President Bombay Chamber of Commerce, and Group President Kotak Mahindra AMC for setting the theme for the conclave. My sincere thanks to our sponsors, the silver sponsor, HDFC Mutual Fund, bronze sponsor, Kotak Mutual Fund, supporting partners, Bandhan Mutual Fund, and Can Rubico Mutual Fund, and media partner Business Standard for supporting us in making this conclave a success. I'd like to thank all the speakers and moderators for today. For panel one, Lata moderated an engaging panel on the topic mutual fund maturity in India, future trends and investor preferences with Nilesh, Navneet, Nimish, and DP Singh from SBI Mutual as panelists. A big thanks to all of them. On our second panel, the shifting regulatory and business terrain, I thank our moderator, Sourav, editor Business Standard, and our panelists, Varun, Sridhar, Dhiraj, Relli, Varun, Gupta, and my friend Kalpen for such a highly engaging discussion. I'd like to thank this august audience for taking time out of this busy schedule and joining us today, despite the fact that there's an India-Sri Lanka game on currently. The BFSI committee has been able to successfully organize this impactful event today. All this could not have been accomplished without the strong and consistent support of the committee and the Chamber Secretariat. I thank each one of you. Last but not the least, I wish to thank the Bombay Chamber team for supporting and making this event a huge success. And finally, I want to also say that I don't think we should be asking market kya lagta hai. I think it is now time to leave all that to mutual funds, because mutual funds sahi hai. Thank you, ladies and gentlemen.
Thank you, Mr. Anand, for your vote of thanks. And thank you, everyone, for being a great audience. Have a great evening, and we look forward to welcoming you again at our future events. Please join us for tea outside. Thank you.